Hi, everybody. This is Leah, and this is Hyperwave, and we have Ty, and this is going to be a big one, actually. We're going to try to demystify our piece. We have a Hyperwave workshop webinar coming up, so pretty much everything we're going to talk about here, which is what we find most important for everybody to understand. It's going to be a bit of a magnum opus of a vlog, and also so Tyler's definitely going to show a lot of really cool charts, but then we're also going to maybe debate each other a little bit in kind of a fireside chat way. So before I get Tyler on the screen, well, actually, Tyler, hello, and then I'll do a little fun overview of what I think we're talking about.
Terrific, great.
Hello, cool. Everybody. What were you saying, Ty?
Hello, everybody.
Exactly. All right, well, to start with, I think it's important, and Tone calling you out here, to really understand, obviously, we always talk about long-term trends. We're going to talk about long-term trends today. Our piece is about long-term trends. Hyperwave is about long-term trends. But there's really three trends that people are interested in, and we want to demystify really a lot of things today, but specifically why we're interested also in these long-term trends. So long-term trends is definitely us. People are interested in swing trends, short-term trends, right? And relate all these three things to tone sequential, which isn't actually trying to do intermediate or long-term, but catch moves as they run out of gas to get people aware of the fact that the short-term nines can turn into intermediate-term nines, then long-term nines, but at each point we don't really know that, right? So we want to talk about today how people right here, right now, really need to understand that there's big forces, huge long-term forces at work, debt being the biggest bubble and issue that we need to look at. And we will talk about, and we have talked about in the Medium article, I'll bring it back up, but that specifically within these huge long-term forces, that doesn't mean that you don't also get these strange movements in between, right? But the biggest long-term force that we follow is Hyperwave, right? Hyperwave channel. So we're gonna also talking about Hyperwave, what's the long-term trends looking like right now? How do we address the biggest issues? And with that, I will be quiet. Tyler, what are you thinking about today?
Yeah, Leah and I, this morning, we were just talking about the confluence of so many forces, all in a very short period of time. And by short period of time, I mean over the last year. It up until a year ago, it seemed fairly obvious what was going on with world economics and country-specific economics, and therefore stock market-specific economics, and therefore asset class movement. But that all started to come apart last year. And as we sit here today, we have run into a bunch of resistance at a lot of levels with a lot of different asset classes. At the same time, Leah and I had just finished our first article on Bitcoin as being maybe one of 4 or 5 possible solutions to the bigger problem, which we would like to stipulate as being world debt. Now, we're not arguing with people about that, meaning that we've come to the conclusion that the world debt growth acceleration has gone beyond the point at which traditional methods are going to be able to deal with it. And that debt problem is demanding a solution which will either come from the marketplace or powers that be will be able to choose an alternative to take care of that debt problem. That presumption on our part may turn out to be false. I don't believe it is, and so we are going to continue to preach just the way we have been, that this is something that if you are attempting to be an investor, attempting to take assets and net worth, and redeploy it in various ways, you must do it within the framework of there is a significant problem that will be solved in our lifetime. If you're 70 years old or if you're 20 years old, it's going to be solved in our lifetime, because it must mathematically. It's got to be reversed, meaning the trend of the total debt relative to the total net worth of the world that can be applied to that debt to make it go away or reduce it. So those of you who have not read the Medium article entitled The Long and Winding Road to Bitcoin $10 million, please do, because it's the first in a series. We are trying to finish up the second, which is going to be entitled something like The Shorter and More Direct Route to $30,000 gold. We've got to work on that, but I'm still working on the numbers. And then after that, we're going to take on the default solution to the problem, which means that governments will not be able to solve the problem in time, and therefore will be forced, along with corporations and banks and the banking system and central banks, to do something very dramatic in terms of reducing the debt by fiat. And then we will look at two other possibilities. One is growth, which is receding very, very quickly as a solution. And then we will end up with our discussion about the Chinese plan to put everything together in one big basket, diminishing the value of the dollar, but increasing the value of individual commodities and individual currencies, including the yuan. We keep asking people for other potential solutions, and we've actually got 2 or 3 that have come in that we're kicking around. But for today, what we want to do is, I just want to make some declarative statements, but in the context of what Leah outlined and what I'm now talking about, which is, unless you just want to sit in cash, which is not a bad idea. I believe cash is king always. But the problem with that statement is, if you stay in cash for too long, you will reach a point at which the buying power of that cash has diminished to the point that you should have done something earlier other than cash. What's the length of time on that? Nobody knows. But with low interest rates and low inflation, that means the longer you can hold cash and not have to worry about taking that cash and putting it into real estate or stocks or gold or Bitcoin. And that is, I don't mind sitting for 2 or 3 or 4 years in cash if there is not an obvious better choice. Most people look at the world of finance from the other point of view. And that is, you take the long-term returns of something like the stock market, and what John Bogle made famous and indexing makes famous is just buying and holding those asset classes that over long periods of time tend to do the best. And I bought into that early on in my career, but the more depth I went into the analysis, the more ludicrous that proposition seemed to me. And it is true that if you take that position at the end of a 10 or a 20 or 30-year run in assets without very many corrections, you appear to be correct until you go through a long period of time where that's no longer true. Well, we are in such a time right now. It began back in 2000, and it still continues today. Because over the last 30 years, 28 years, what's happened is we've had a couple of tremendous drops in asset classes that the only solution to those drops were to create more and more debt, which brings us to where we are today. And we've talked about the fact that certain assets, like the NASDAQ stocks, only recently got back to where they were back in the year 2000. And things like credit, meaning treasury bonds, treasury notes, treasury bills, after going up and up and up in terms of yield, and therefore down and down and down in terms of value or price for 40 years, reversed that trend. And the last 40-year trend just ended several years ago. So we're at a point right now where it seems unbelievably complicated and difficult to understand where we are. But that is only true if you just pick an asset class and try to do technical or fundamental analysis only on that asset class, such as crypto and Bitcoin. Too many people exclude all of these other factors when thinking about crypto and Bitcoin. And what that means is for an 8 or 9 year period, everything went perfectly well until it all came apart. But it all came apart because of tremendous forces outside of crypto and outside of Bitcoin. Some of it was internally generated because of the immaturity of the asset class, but much of it was externally generated because when you get a 10-year bull market in stocks and in economic growth in around the world, but particularly in the US, that becomes more and more difficult for those people that are enjoying that kind of acceleration and appreciation to risk any money in something that all of a sudden can lose 80% of its value. So even though those within the ecosystem became married to the fact that this thing is divine, and therefore its future is assured, have come to the realization, hopefully, by getting outside of that particular womb and looking at the world as it really is, not the way they want it to be. Okay, why am I talking about all this? Well, for the first time, we introduced Hyperwave to the public in Las Vegas, and we sold out almost twice as many seats as has been allocated to us, which told Leah and I that this thing that people hadn't heard about before, first of all, is a real thing. And that as more and more people look at it, understand it, and study it, it becomes more and more real, not less and less. And the response was very positive, so that Leah and I decided that rather than getting a bunch of people to have to fly to a location, or we have to fly to a location and try to get people together at that and pay for hotels and pay for flights and pay for meals and all of that, that we were going to try in a couple of weeks to do the exact same thing we did in Las Vegas, the exact same content, but we'll do it in a webinar fashion broken up into 2 days, 4 hours on the first day, 4 hours on the second day. Now, the reason a lot of people are saying, oh, you know, all they're trying to do is monetize this thing and all of that. Absolutely true. This is Leah's career. She began it a year ago with me. I've been doing this for 40 years, and this is a very valuable piece of information. It's proprietary, but we don't want it to be proprietary. So the question is, how do we best take advantage of the fact that the timing is perfect for people to learn this thing? Not for Bitcoin. That ship has sailed. The hyperwave on Bitcoin came and went. We're in the terminal end of that hyperwave. It might be another 12 months, who knows? But that's not the point. The point is there is this tool that can be applied to all markets at all times, to the credit market, to the Japanese stock market, to the US stock market, to Google and Netflix and Facebook and Amazon and stocks all over the world. Also to industries and sectors all over the world. It's a very powerful tool, but if you wait until you're on the back side of it, on one specific thing you're looking at, it's too late. Yeah, you can short it. You can short that thing, or if you're in it, you can get out of it. But what we're trying to do is to expand everyone's consciousness in terms of tools that are available to look at all of these things, not just one thing at one particular point in time. Therefore, we're going ahead and doing that, and we'll be talking more and more about it. But it's very inclusive. We include 25 hyperwaves that are active right now at various stages, phase 1, 2, 3, and 4, as well as 5, 6, and 7. But more importantly, you're going to learn how to find them, how to use them, what each stage means, so that hopefully you come away saying, my gosh, they were correct. This is a real thing. And just because no one else has talked about it or used it in the past, I believe that it deserves the opportunity to be considered in detail, and it will be money very well spent. Now, I've said over and over again that back in 1979, I paid someone $2,000 to learn the sequential trading system. Larry Williams gave a set of seminars. He limited the number of people, but then he taught them in detail how sequential worked. Well, that was $2,000 in 1979. That means it's $5,000 or $6,000 or $7,000 or $8,000 today to learn that system, and I would do it in a second if I hadn't learned that system. But I would have been very reluctant unless I had proof of how it works. So a year ago, when Leah and I began talking about the reason we believe Hyperwave in Bitcoin ended in terms of the upside of it back in December of 2017, wasn't a random thing. It wasn't an analyst guessing, ooh, maybe it's gone too far. Maybe this bubble is burst. It has to do with very specific rules that we will teach everybody, so that the next time and the next time and the next time, 3 years from now, 5 years from now, 20 years from now, 30 years from now, you will have this tool at your disposal that you will find to be a very powerful timing tool that will keep you into things without having to worry about all the short term, the intermediate term moves, because we're talking about years and they will get you out at the right place at the right time. Okay, enough of that for now, but you will be hearing more and more about it. I'm going to be putting more content on our website about what we will include. And remember, the people that came to Vegas to learn this, unfortunately, we were not able to tape it. We wanted to be able to tape the entire thing. One of the things we're able to do here through this webinar, through Zoom, is everybody will have access to the entire presentation for as long as they want afterwards. You'll be able to go back hour by hour, phase by phase, example by example, until you really get it. And then obviously we will be available for any questions people have from what they heard in that webinar. Okay, let's talk specifics. I'm calling this the mother of all bubbles, which is the credit bubble. I've already shown you that the largest hyperwave ever was 80 years long, and it was a credit bubble that started in 1942. It peaked in 1979 when Paul Volcker, as the Fed chairman, killed inflation and started a 40-year decrease in interest rates and inflation and a 40-year bond bull market. I wrote a piece in 1985 called The Case for Bonds, where I predicted that we would fall from the 10 to 11% level on long bonds all the way down below 3%. But it would take years and years to get there, which it finally did. Now, here is why that is important. Leah mentioned to me that several people that follow us very closely, partners of ours, think that one of the biggest problems with current macroeconomics is debt, and they're absolutely correct. But take a step back and listen to what I just said. The biggest bond market, the other term for bond is debt. You issue a bond by going into debt and you ask people to loan you money. The US does it through treasury bonds, corporations like IBM do it through corporate bonds, municipalities do it through municipal bonds, all the way around the world. That's what debt and bonds are the same thing. Debt and notes are the same thing. Debt and bills are the same thing. We had a 40-year bull market in bonds from 1979 to just a couple of years ago. That made it an asset class that during various points of time along the way, 1987, 2000 through 2003, 2006 through 2009, and over the last year, was the best place to park your money because you got a better return than cash. And as long as interest rates weren't going up at a faster rate than the interest you were being paid, you got appreciation in your bonds plus a return on those bonds. So when you're talking about debt and the mother of all bubbles, you've got to be nuanced in terms of if you're talking long-term, intermediate term, or short-term. There is nothing evil about debt. There is nothing evil about bonds or credit cards or mortgages or car payments. The thing that becomes evil is where you allow that to grow to an extent that you cannot control. And when you cross that Maginot line or that Mason-Dixon line, when you step over that boundary, you have gone from good to evil, from positive to negative, from wonderful consequences, if it's controlled, to horrible consequences that you cannot control. So when Leah and I talk about this debt situation on a worldwide basis, we are stipulating that debt that had been good, had been useful, and had been productive, we've crossed the line, and now a solution must be found. Now, the other thing I wanted to talk about is what that means in the asset classes that we outlined in our article. And remember that we talked about central banks, we talked about world banks, the IMF, the banking system, national banks, regional banks, sovereign wealth funds, real estate, all real estate, commercial, residential, raw land, all pension funds, all stock markets, all currencies, everything, all gold, all cryptocurrency, which doesn't show up on any charts because it's so insignificant at this point. All of that taken together is world wealth. And where world wealth is growing at only 1/3 the rate of world debt, the world has a problem. And there's only certain people that are in a position to try to solve that problem. And that's what centralization causes. It causes both the benefits and the problems to be in the hands of very few. And if those very few sitting as finance ministers or central bankers are relying on even more centralized decision making in the form of the Federal Reserve in the United States, the World Bank, and the IMF. By the way, David Malpass has just taken the seat as of, I believe, yesterday, as has been traditional that an American would take that seat and a European in general would take the other seat that was set up by Bretton Woods in 1944, the IMF and the World Bank. When you've got even more centralized decision makers, that means you've got fewer and fewer people that are actually being forced to make more and more difficult situations. And as I have said, I stand in awe at what the Federal Reserve in the United States was able to accomplish on 2 different occasions between 2000 and 2003 and between 2007 and 2009 to save the world's macroeconomic stability. But because they had so few tools, they had to invent new tools. And those new tools resulted in the problem getting even bigger and the ammunition they have even smaller. Now, if the world were able to vote on a solution to the problem, which it doesn't, but if the world, meaning 7.5 billion people, could raise their hand, and 7.5 billion people were well schooled in the things we're now talking about, what Bitcoin is, what a gold standard is, what default would mean, what a basket of currencies would mean. If everybody could vote on one of those with an equal amount of information about each, I believe that the world would vote for Bitcoin. But so few of us know anything about it, and so many of us, of that few, still don't get it right because we mix up cryptocurrency with Bitcoin in our minds, and we are lulled into being willing to play games with these cryptocurrencies to make a fast buck, not realizing that what we're doing is we are convincing all of those unschooled that Bitcoin is not a player in this big game because we've just confused all the issues. And we as a group have got to work that out ourselves. Hopefully time will make us capable of doing that. Up till today, that has not been the case. So other than that, I guess that if 7.5 billion people had equal voting rights and equal information and education about these issues, they would choose the gold standard for a lot of reasons that we'll go into in our next article. Hopefully that'll come out next week. Everybody would vote for the one that is not going to occur in my mind, which is growing out of the problem. And we will do that as soon as we do the default, because I think that's the most likely of all the scenarios. But what my point is today is that the reason that this is going to be such a difficult period starting a year ago into the end of this year and next year and the year after is because we do not have a decentralized form of voting. And it's a good thing that we don't. It's a good thing because so few people are schooled in even the basics of what we're talking about in terms of economics and finance and how the system really works. What we tend to do is we lump these things into big, ugly buckets, and then we ignore them. We say debt is bad. We say central banks are bad. We say that the banking system is corrupt. We say that capitalism is corrupt. And other people say socialism is the way to go. This political system is the way to go. And we end up lumping what should be easily accessible information by which you can draw logical conclusions that give you ranges of probability of how things will work under different scenarios. We give that up, and we give it up to institutions that give it up to smaller institutions, but more powerful, that give it up to tiny, tiny institutions where a very small number of people sit around a table and determine how everything is going to play out. If you don't think that is what's happened over the last 20 years with the central bank in the United States affecting all other economies around the world and all asset classes and all asset bubbles in real estate, in mortgages, in the stock market, then you haven't been paying attention. And what Leah and I are attempting to do is step by step give you the structural, intellectual means of pulling that information together for yourself, so you don't have to rely on Tyler or Tone or Hyperwave or Sequential or this person or this company or that. You can do it yourself. It takes work, and you've got to be willing to do it, but it's your money. It's your wealth. I define wealth not in terms of money. I define wealth in terms of number one, time. Number two, education. Number three, experience. Number four, practical use of tools that can be implemented, understood in an easy fashion if you work at it. And many of you who have responded to us have done just that. We get more from you than you've been getting from us, because what you do is you take the time to listen, understand, and then question. And we're getting great questions that I never got before on Hyperwave because I kept it to myself. So one of the things we want everyone in this space to do is to contribute, but you're contributing because you are gaining knowledge about things like retirement accounts. We were shocked when we did one simple vlog on retirement accounts, the overwhelming response by people saying, I had never known that before, having to do with that's where you start because you can put assets in it, write it off of your taxes and not be taxed on it for 10, 20, 30, 40, 50, 60, 70 years, which allows it then to accumulate at a faster and faster rate than it would have outside of that. And on, money management systems. Money management systems aren't games that are played on Wall Street. They are sets of rules that have been imposed on money managers to make sure that their fiduciary responsibility they take over other people's money is soundly utilized. That's what money management is. Money management isn't making money. It's managing risk and managing potential reward. So those are the kind of things we're trying to bring to people. But then I started thinking, the most important thing people can get from YouTube videos, I believe, is the ability to listen to different people and to come to conclusions about what their motivations are and what their experience is and what tools they are bringing to you that help you. Various tools work for various people. Almost nothing I have said in the last year has been helpful to day traders. I think I could, because I do a lot of that myself and have for the last 40 years, but that's not what we're trying to achieve. We want a much bigger perspective where the important things in your life are understood relative to this thing called wealth and this thing called money management and taking care of your own needs. So many of the people that have ended up as consulting clients don't want to consult to hear my opinion. Originally they do, but they want to know how do they need to think for themselves so the next time and the next time and the next time they can do it for themselves. And that's what we're trying to do. And one of the best ways I think we can do this is through our webinars. And yes, we do charge what I think is reasonable amounts of money for our time and our experience to bring that to you. Many of you don't agree with that, and that's fine, but a lot more do agree with that, and we're very pleased that we will keep doing that until we overstay our welcome. Hopefully that will not come for a long, long time. We've got a lot of very interesting and I think important things to bring to you. And I just wanted to quickly go over all of that today. One of the other things I wanted to do is to bring this right down to where we sit today in terms of the markets and why I made the tweets this morning that said, these are trendless markets right now. And the best place to be in a trendless market is in cash. It's not trying to guess where it's going to go. Even if you've got probability on your side, if there's the risk that it can change quickly. So what I'm going to do now is I'm just going to quickly bring up some big charts. We're not going to look at stocks or individual currencies. I want to look at big asset classes. And the way I'm going to do that is I'm going to look at some very big charts, but we will start with the one that brought us here, which is the Bitcoin chart. And then we will go to other major. Okay, let me see. Let's get out of this. Let's move this down to here. And let's move this one up to here. And let's do that. Okay. This is a weekly chart. And I'm going to go through what I have done for the past year. I'm going to first roll it out. I said I've become disinterested in this market. I became disinterested as soon as we broke down through 6,000 because it told me that the phase 2 of a hyperwave was not going to hold, and that means we've got a long way to go to the downside. I've also said I will never short Bitcoin. The reason for that is I will short other cryptocurrencies if I had the time to care about it, which I don't, but not Bitcoin. Bitcoin is the real thing. It's the only real thing in the crypto space. It is not going to die. At some point, it will be given a chance to prove itself. That point has not yet come. I come to all of those conclusions because of Hyperwave. When we teach our workshop on Hyperwave, we will look at Bitcoin, but only as a rear view mirror look. What we're really interested in is showing you how and why to detect hyperwaves as they are beginning, not as they're coming to an end. And I know very few people buy into that scenario, but I have since December of last year, and I still do today. This is a trending market. The trend is down. It has been for over a year. These stop and reverse points are the easiest way to tell what the trend is. If they're flipping back and forth, that is a trendless market. If all of the dots are coming down except a brief period of 4 weeks that we had an interruption, that is the best of all kind of trends. Anyone in this should have been out as we broke down through the bottom of the stop and reverse points, or out when the fourth phase of a hyperwave was broken, or out when Consentio gave you a sell signal, and you would have been out ever since. And you should have been out ever since from a money management point of view. Why? Because you've got your money tied up in an asset that is trending lower. And while it is trending lower, that money would have been much better spent either in cash or in a trending market that was trending in a way that you could take advantage of. I'm going to just overlay very quickly Consentio to show you the same thing, but I'm going to take off the price. This is a market that was trending up and then has been trending down, and it's been trending down ever since without a break, all the way from 10,000 on the long-term moving average moving down to where we are today. So there are simple tools that you can apply over any and all asset classes and any part of an asset class. Okay, enough on Bitcoin. What I'd like to do is now pull up the other markets. And I will do that. by going here, by going here, by bringing this up, and by bringing this up. Okay. Here is the Dow Jones Industrial Average. This is a monthly chart going back all the way to 2010. This is a trending market. This, at the end, is not a trending market. I'm going to go down to the weekly. I'm going to roll it back to the end of 2017, the beginning of 2018. Take a look at where we are right now and go back, and you will see that we have not moved in a year. Now, some will say, yes, but what about this upswing, this downswing?
Ty,
Yes.
are you trying to screen share?
Excuse me?
Are you trying to screen share right now?
Yep.
You're not screen sharing.
Okay. Let's try it again.
You were with the Bitcoin chart, though. All right. While Tyler does that, everybody can see my office. Or the canal, actually. It's really pretty here in Georgetown. Yay, Tyler got it up. All right, Ty.
Okay, good. I will go back. Sorry about that. We will start with a monthly chart of the Dow Jones Industrials going back 10 years. This was a trend for 10 years. There was some flatness along the way, but basically month after month after month after month, we made it all the way until a year ago. So now we will go weekly to take a look at this past year. And what we see here is where we are today is sitting right on the middle of a Bollinger Band, sitting right in the middle between the upper Bollinger and the lower Bollinger, sitting at a confluence of moving averages, all coming together at the same place at the same time. But look at the price today compared to the price at the beginning of this 1 year period. We're exactly where we were. That is a trendless market. And it means that no matter what technical trading system you are using, if you're not focused on the long term, if you're looking at intermediate term, you would get out, get in, get out, get in, get out. And if you did that perfectly, you could make some money. But what this price tells me today, and back here, and back here, and back here, that if you didn't do any of those things, you just bought and held, you'd be exactly where you were a year ago. Now, a bunch of people in the crypto market had been saying, well, why get out of Bitcoin and get into something that is destined to blow up and fall apart because we've already had a 10-year bull market? Well, the answer to that is if you had gotten out and just in cash, you would have saved 80% of your money as opposed to staying in Bitcoin. If you had stayed in this asset class after a 10-year bull market, didn't buy, didn't sell, just stayed in it like John Bogle says to do, you would have zero return, but you'd be 80% higher than you were by staying in Bitcoin. You need to constantly look at all asset classes relative to each other relative to exactly where you are in time in terms of trends. You want to be in those trends that are increasing and out of those trends that are decreasing. Now, I have been arguing for a year that I believe that the economics of the US economy are such that 2019 is going to be a positive year. So because of that, we got out of a zero weighting in this intermediate downtrend when it got to a point where it was beginning to be oversold. And we had both cash and long positions, as well as inverse ETFs and mutual funds, giving us a zero weighting as the market came down to the bottom. In December, we took the inverse positions off and only held anywhere from 40 to 50% in the stock market and the rest in cash. I'm now seriously considering putting the inverse positions back on so that we have a zero weighting in the market. Why? Because we're in a trendless market. And the risk is that we're not going to be able to go above certain levels on the US indexes. Tone has been talking about it. The S&P hit a 9 on the sequential on a weekly basis. It has turned down precisely where it should after reaching this longer term moving average on a wick, and now it's turned back down to the middle. Now, I'm not ready to say that we are starting down into a bear market. I am not ready to say that we're going to break on through this after a 1 to 4 week decrease in S&P prices, but it certainly looks that like that's the minimum the sequential system is telling you, that we've got a 1 to 4 week pullback, which could be 1 week, it could be 2, could be 3, or it could be 4 before moving higher. But sequential also says that this could be the beginning of a 9-week pullback. And that particular system, the sequential system, doesn't give you the ability to foretell what that's going to be. And since to me the most important thing is the preservation of capital, as opposed to trying to make money where the probabilities are running against you, it would make sense for most clients, if they were long, to be getting back into some cash or maybe all cash and waiting for this next 1 to 4 week period to take place. Now, I started thinking that's unusual that all of a sudden we're seeing the Russell 2000, the Dow Jones Transports, the NASDAQ Composite, the NASDAQ 100, and the S&P and the Dow all in the same place, right in the middle of a big trading band, with the ability to break up through and go to the top or to break back down to the bottom. So that's an easy call for me as a money manager. It's a very difficult call for most people to make. I've got a lot of consulting clients who don't really care about this long-term trend stuff. What they're doing is they're buying puts or they're buying leveraged ETFs and placing bets with close stops on short-term trades to go either up or down. That's a wonderful strategy if you've got a lot of time on your hands and you're willing to risk a lot of money. That's different than what Leah and I are attempting to bring to you. We are talking about long-term trends, long-term preservation of capital, long-term money management. And so everything that we tell you, everything that we teach to you is from that perspective. That doesn't mean you can't use tools to trade the intermediate term bounces, to trade the short term bounces. It's simply that you're not going to hear us talking about that, but please don't mix that up with us not being cognizant of the fact that all of those short-term, intermediate-term, and longer-term strategies are at play every day, and that some of you need guidance in those things or need tools to help you with that, and we'll be more than happy on a person-by-person basis to answer the best ways to handle those situations. And with that, we've gone on a lot longer than I wanted to, but we've covered an awful lot of material that hopefully some of you think is important. I know that I do. This is not something I just woke up and decided to talk about. It's because Leah and I have just celebrated our first anniversary of our first vlog on YouTube, which was back in late January of last year. And we've gone through a process of refining what our story is, who the audience is, and what we believe is the best way we can bring information to this particular audience to help them not make decisions for this week or this month or this year, but literally for the rest of your lives. And the way we are going to do that is by teaching what we have learned through our experience. And with that, I am going to get off of these silly things and back to my talented partner.
Thanks, Di. Yeah, we did go an hour, but that was fantastic. So I think we'll leave it there for today, unless you want me to hit you with some fun questions in relation to what we were talking about.
No, that's great. If there's any that look promising to you, or if you've got some, and if I've got some, I'll ask myself.
Nice. Well, actually, I was going to be a little selfish today and ask my own. Hope that's okay, everybody, but I will look at it. So let's dive into what we were talking about this earlier and what was done in the past. You were talking about the Fed, who has done specifically 2 times in the past that you were in awe of, if I got your quote exactly. So let's talk about a little bit about debt and what's been done in the past. So again, what we were talking about is that, well, one, from a macro level picture, we really want everybody to understand debt, but also as it comes down into the nuances, even to the corporate level. But specifically, right, debt spending is Keynesian econ, and it actually works tremendously until it doesn't. When you allow debt and interest on that debt to be beyond your ability to pay it off, that's when it stops working. Okay, now everybody in Bitcoin, so like we got to demystify some of this, right, Ty? And I could be full of blank, but so please cut me off. But everybody, for the most part, in Bitcoin are oh, thank you for the tips. Austrian economists, they follow Mises. So pretty much, if we continue in that thought or train of thought, I can't think, I need more coffee. Then you have the Mises folks who come along saying we continuously make the mistake of spending too much. So they say, don't get into it at all, right? And this is Austrian School of Economics. Just don't play with that formula at all. It doesn't say that it doesn't actually work wonderfully well, like getting you out of a war situation, as you were telling me earlier before the show, and saying that, now you need to build quickly because everything was destroyed. But it's saying, just don't touch it. Now, Ty, when are situations when debt spending is important? And why specifically have we just gone to a point where, we're at such a bubble and a terrible situation? When was it, and why is it that there have stopped being the controls to keep it appropriate?
Yeah, that's a question, obviously, that there have been many, many books written on from all schools, the monetarists, the Keynesians, the Austrians, and all types of other ways of looking at economic activity. But just in brief, I don't like to fall into the trap of labeling a certain way of thinking as being either correct or incorrect. A lot of very intelligent people have spent entire careers putting these theories and ideas together. And they've thought through all of the same things that we think through when we think about these. But what tends to happen is Keynesianism basically tried to come up with a way, and it's important, we can gloss over a lot of this stuff, but it's important to understand who John Maynard Keynes was, and the fact that he was a wild speculator in commodities before he became an economist, and he lost a lot of money. He learned the financial system from the inside out. It wasn't academic to him. But you need to read the biographies and understand the time he was living in. That's where Keynesianism came from. It came from this period of time where there were bank panics, the establishment of the Federal Reserve System to attempt to try to mute the animal spirits brought on by monopolies and trusts that could move things in certain directions against the betterment of most people. And so things were built and then destroyed through World War I, and then rebuilt during the Roaring '20s, destroying the Weimar Republic through hyperinflation. And that was where he began to put all of his ideas together. Pulling out of something like World War I or World War II. World War I, what resulted was a League of Nations. Let's get a group of people together with many different interests, and let's share those interests so that we can come to a common conclusion for the betterment of everybody, until that fell apart. And then after World War II, the United Nations, let's try it again, put all of these things in place. Bretton Woods, 1944. Let's come up with a new financial system to help pull us out of this tremendous destruction in Europe and in Asia, China, and in Japan. We need to stimulate things. We need things to get going. But let's do it differently than we did prior to having to go off the gold standard, back onto the gold standard, having bank panics, having no insurance, have no 1933 Securities Act, no 1940 Investment Advisor Act, no FDIC, no SIPC, none of those things were in place until the problems were so severe that you needed to do something. Well, that's where Keynesianism came from. Deficit spending is a way of accelerating growth because you've got your wealth that can be spent, but if that wealth isn't spent sufficiently to solve a problem like a depression or a deep recession, what other ways can we do it? Well, we can use that wealth as collateral, and we can come up with other ways of using that collateral that can increase monetary, the money flow, which then gets into the multiplication of effect of money if used in a certain way. So instead of just being able to spend $1 on a problem, you could spend $3. Okay, that's a wonderful invention, a wonderful academic construct, and it works until you don't have a governor switch to slow you down and you go faster and faster and faster because it feels so good. well, we were able to take care of this problem and that problem, but there's 3 more problems. So let's go from 3 times to 6 times. Let's go from 6 times to 20 times. Let's just keep printing this money. And the Austrian school comes and they say, basically, human beings are not capable of governing themselves without restraint. So the restraint has got to be in some form, let's call it a gold standard, or some kind of a standard that will only allow you to go 30 miles an hour on this winding road, as opposed to 60 miles an hour, where 50% of the people going 50 miles an hour, 60 miles an hour, end up flipping off the road and getting killed. So, one, the Keynesian school, and 2, the Austrian school, take opposite views of the nature of humanity. And then in between somewhere is the monetarist school, and all the other schools fit in there also. And this isn't a lecture on economics, it's the practicality of what Leah's question is about, which is, why did I say that I was amazed at the ability of the Federal Reserve to maneuver in such a way as to change all of the historical norms and regulations and rules that had been imposed on them in such a fashion to come up with new innovative ways of skirting what they had the ability to do for 60 years, and come up with new ways of doing things under the guise of, we need to do this for our own economic security. And since we are the ones that have been put into the position to make those decisions, not the president, not the legislature, not the Supreme Court, not the judicial system, just us, this little band of folks that sit around a table, they came up with a way out of nowhere to pull us out of a very deep problem in 2001, 2, and 3. And put us into a deeper problem having to do with real estate and mortgages that they came up with other ways to pull us out of in 7, 8, and 9, 2007, 8, and 9. So the Austrian school looks more and more reliable compared to the Keynesian school because of our recent past. If and when we get out of this mess by doing one of the 4 or 5 things that we're talking about in our Medium article, then Keynesianism might very well come back, because it's going to be needed to pull us out of the bottom of the next mess, regardless of what solution we come up with. So that's why, rather than labeling an institution or a way of thinking as always being good or bad, just know what the implications are of what those institutions can do, have done in the past, and might do in the future, and what's the implication for you and your money and your wealth and your time and your education and your experience to be able to protect your family from all of this noise that's going on around you. And there are ways of doing it, and that's what we're trying to teach.
Ty, we got a tip. It's so exciting.
Wow.
And actually, I think it's a really interesting one. I don't know how familiar you are with Brent's dollar milkshake theory, but as kind of a background, and it's actually a really, really interesting question. Thanks. And we got a Starbucks amount of tips, so it's very
terrific.
I like coffee. So my understanding of Brent is that he's a real gold bug guy. And even though he believes a lot in the future of gold, he thinks that one of the biggest issues is the dollar. I think he called it, I know, the dollar milkshake theory. I think it's actually dollar rather than just milkshake theory that was mentioned there. And my understanding of what he was trying to say and I could be wrong, is that given all the financial crisis and exactly what you're saying today is that all the central banks got together to fill the financial system with liquidity, with low interest rates, asset purchases, QE1, QE2, QE3, all that good fun stuff. They turned the financial markets into a frothy milkshake, I believe is where you like got the idea, and with sky high bonds and stock prices and all that good stuff. So I'm going to turn this into a question for you. Let me think about what would be fun. Okay,
I do like milkshakes.
I do too.
If that's your question, I do like milkshakes.
I like chocolate ones. Okay. Okay, let's relate it to the dollar index, which, it values the dollar against a basket of other currencies. Dollar's been rallying. We've been talking about the strengthening of the dollar. Question regarding what milkshake theory is saying about the issues of the dollar and it creating frothy milkshakes in the financial markets. What are your thoughts on if the dollar continues to strengthen and how that will impact not just the United States, but global economy? Big question.
Well, the problem is the dollar isn't strengthening. It hasn't moved for a year. It's inched up from 94 to 96, almost 97, back down to the low 95s. It's now back at 96. It's not moving anywhere. It's halfway in between a top and a bottom for the last 25 years. It is the strongest currency over the last 5 years, the last 10 years, but we're not talking about a runaway dollar in any sense. And one of the reasons I was very negative on the precious metals until last week, where we took a small position in both the GLDs 5% and the GDX is 5%, is because the dollar wasn't going anywhere, but gold and silver kept moving up. Platinum and palladium were getting stronger. Palladium was doing stupid things, but basically precious metals began to act as if they really wanted to get back up on gold to the old highs at $1,380. They made it to almost $1,330, but they've slipped back to $1,315, $1,310. So what my point is yeah, I understand that the rest of the world is long ago irritated with the strength of the US dollar relative to their own currencies. And certain places in particular, like China, and certain places in particular, like Russia and the Middle East, where they want to start experimenting with using something other than the dollar for petroleum purchases. I understand all of that, but right now, the only economy in the world that you can be satisfied is actually growing at rates greater than inflation rates or interest rates is the US. China says they are, but nobody believes them anymore. But other than that, you got 219 countries around the world that, yes, some of them are rallying, like Brazil and others, but that's because they did so horribly for so long that now they're bouncing off of bottoms. I'm talking about economically, not just stock markets or currencies. I'm just saying that the dollar is still king to the world. But that king has been sitting on his throne for the last year and not moving. And every time he begins to stand up, he gets knocked back down again. And a lot of that has to do with interest rate policy in the United States. If the Fed continued raising interest rates, the dollar would get stronger and stronger. But the Fed now has signaled they're not going to do that. So the dollar has settled back down again, and gold and silver have been coming back up. That's why we're doing this show today, because no matter which asset class you talk about right now, they've all ended up getting crushed in this center where they can't break out to the upside or the downside. And that's because of everything going on, all of these much, much bigger pressures that no one is sure. They don't want to put their head over the fence and take a peek because they could get their head blown off by making a wrong decision. And that's where we are today. That's a great way of kind of ending what we were trying to do today. Is I like to use the term slap yourself, go over to the mirror and slap yourself and wake up, expand what you're looking at, what you're focusing on, and get an understanding of the size of this thing we are talking about. I keep using hyperbolic terminology, such as never in world history, never in civilization, never in macroeconomics have we come to a point such as the one we have now come to. Therefore, there are no answers. There's no one to turn to say what happens next. And when you find yourself in that position, the best thing to do is stand still. Don't keep moving. Get into cash and look at the alternatives and wait for the evidence to come in. Let the markets come to you. Don't you attempt to dictate to them what you want to happen. And too many people are doing that right now.
So last part of that question, also, someone mentioned China, which we do love talking about, and obviously why I'm wearing red, because it's the Chinese New Year. So everybody who's listening, 恭喜发财. So hopefully that helps out. Last part of the milkshake analogy, let's have a little fun and then let's finish it for sure, is are we going to be able to suck up the liquidity?
Are we going to what?
Be able to suck up the liquidity.
It's a tough question because it depends on how you define liquidity. There is not very much liquidity in the world. And the reason there's not very much liquidity is because that went into certain bubbles that should have gone elsewhere. It should have been in the banking system, lending itself out to corporations and individuals, but it wasn't. The money that was created over the last 20 years by central banks was used by the banking system to help the banks, used by corporations to help themselves by corporate buybacks, and did not make it out into the world economy in general. And it's pretty much used up. One way of increasing that is by lowering interest rates again. But you can't lower them in 90% of the countries around the world because they're at the bottom or slightly negative or slightly positive. Therefore, the stimulation is gone that creates liquidity. Liquidity is created by dropping rates, putting that excess liquidity into the banking system and having the banking system lend it out at low enough rates for more and more people to be able to take advantage of them, which is what Keynes was all about. And then the monetarists after him were all about is let's get this money moving through the system, not going into a localized thing like mortgages that really are just banks and big mortgage companies, or into things like the stock market, which can be taken advantage of if the trend continues up. But where it's really taken advantage of is corporations and banks and Wall Street, because everybody is gaining through that bubble. But that's very different than liquidity in the economy.
All right, Ty and everybody， 我的中文很较好，但谢谢你。well, it's really 祝你今天愉快，再见，谢谢。我除了在北大这上个月，and Tyler.
I'll have chocolate milkshake, please.
Not strawberry.
No, not this kind. Thank you, everybody, very much. Please go to our website. Take a look at what we're offering in terms of our webinar, which is a week from this weekend. It'll be Saturday from 12 to 4, Sunday from 12 to 4. And we know you will get a lot out of it.
All right. 谢谢。再见。
Au revoir.